Hello and welcome to a new episode of the Sustainability Channel. I'm Thomas Stanley and I'm your host. Let's start today's news update with an article from Yahoo Finance. And Wall Street is paring its bets on ESG and DEI as political pressure rises. So big businesses keep backing away from ESG and DEI as the political heat around these buzzwords mount in an election year. Companies are reducing their involvement in a high-profile climate group, talking less about environmental, social, and governance concerns on earnings calls, and paring back new hires devoted to diversity, equity, and inclusion in workplaces. The latest retrenchment came last week when financial giants JP Morgan Chase, State Street, and PIMCO all pulled out of Climate Action 100 Plus, a coalition formed in 2017 to encourage companies to reduce their emissions. BlackRock, the world's largest money manager, also ended its US involvement with the group, and this is something we reported in this channel earlier on. A JP Morgan asset management spokesperson explained the decision partly as a result of the firm's development of its own climate risk engagement framework over the past couple of years, adding that we believe that climate change continues to present material economic risks and opportunities to our clients. The moves followed a wave of political pressure on the climate coalition, with the House Judiciary Committee Chair Jim Jordan even issuing a subpoena. In a statement, Jordan called the withdrawals a big win for freedom and the American economy, and we hope more financial institutions follow suit in abandoning collusive ESG actions. The GOP is applying pressure on other fronts as well. Former President Trump has promised to banish ESG forever, while a top Trump ally has called DEI bigotry. Republican-led states are also aggressively pushing companies to revisit their DEI policies and suggesting they could even be illegal. Companies are shying away from ESG and DEI in other ways. One has to do with what they discuss on their quarterly earnings calls with analysts. A recent analysis from FactSet found that mentions of ESG on S&P 500 earnings calls were set to reach new lows this year compared to earlier in the decade. Direct mentions of DEI were even less frequent. Mentions are dramatically down from recent high water marks, including a 2021 that saw over 100 mentions of ESG each quarter. Another change from companies is that they have slowed their hiring of people with DEI attached to their titles. The step back by corporate America comes as political fighting over these topics is expected to increase. But a new poll released Thursday from left-leaning group Unlocking America's Future found that American voters are largely unfamiliar with terminology like ESG, but responded very positively to terms like responsible companies and sustainable business practices. So I think maybe just the vocabulary needs to be adjusted. So let's continue with an article from Forbes, How to Recognize ESG Reporting Risks and Opportunities in 2024. ESG reporting has evolved into an essential cornerstone of corporate well-being due to its influence on critical stakeholders. According to Gartner, 85% of investors consider ESG factors in their due diligence, and employees and customers are also paying close attention, with 66% of consumers saying they would pay more for sustainable products. With this shift in mind, our research found that 90% of senior accounting and finance executives are looking to implement new sustainability goals over the next 2 to 5 years. Before organizations set these goals, however, they must first understand their current impact in these areas. Thankfully, different regulatory bodies have started to announce reporting guidance to ensure businesses are drawing from comparable and meaningful datasets. Recently, the International Organization of Securities Commissions endorsed the first ever set of ESG standards from the International Sustainability Standards Board. ESG data can be sourced from almost anywhere in an organization. Utility meters, service contracts, facility management software, HR software, and fleet management systems are just a sampling of the sources. Each uses different units of measurement, scopes of data, and reporting methods. Without a centralized system of record in place, the teams collecting and analyzing these data may make critical errors that could create a web of issues, resulting in anything from non-compliance to potential fines to thousands of employee hours wasted. Successful ESG reporting requires accurate collecting, monitoring, documenting, and reporting on a massive volume of dynamic data, such as waste management metrics, energy consumption, and greenhouse gas emissions. Employees are beginning to push back when their employer lacks ESG commitment or shows no follow-through. For example, Amazon employees stage a protest citing a lack of trust in the company stemming from, among other things, its carbon emissions jumping 40% in 2021 from 2019. Conversely, there's a reason that employees consistently name Patagonia one of the best places to work in the US. Many top business schools study Patagonia's ESG-focused business model, and in 2019, the company reported an astonishingly low 4% employee turnover rate. A 2022 survey by EY revealed that nearly 70% of companies had higher than expected financial returns on beneficial climate initiatives. Additionally, business activities that support sustainable development goals account for 53% of revenues of the 500 largest US companies and 49% of revenues of the 1,200 largest global companies, according to research from S&P Global. Being proactive about an ESG strategy and transparently sharing relevant data demonstrates to investors that the company is thinking of the longevity of the business and its reputation. Very interesting, and this once again shows that it's more important to focus on the results more than the words and the terminology. So the last article from Harvard Business Review, 2 factors that determine when ESG create shareholder value. A main criticism of corporate sustainability has long been that it results in firms not putting shareholder first, thus contradicting managers' fiduciary duty. And the author of this article has documented that considering financially material ESG factors, for instance, those sustainability activities that are related to the core sector practices of the firm, improve portfolio returns, which is consistent with financially material sustainability activities, creating shareholder value. And some attributed the paper that the author of this article wrote to ESG investing taking off. The Financial Times called the paper a turning point on how investors viewed and integrated ESG information. Yet, despite its popularity among investors and managers, sustainability remains a contentious topic. Academic consensus about whether it creates shareholder value has remained elusive, and ESG investing has become caught up in a political war in the US, with some conservative critics claiming it's a fig leaf for promoting a liberal agenda, and some liberal critics criticizing it for not going far enough in addressing planetary challenges. Yet ESG investing is not going away. Almost all companies still claim to engage in some form of ESG. So, understanding the link between ESG efforts and shareholder value remains as important as ever. And the author have been uncovering the link between ESG and shareholder value creation, and he describes 2 examples here below. First, the importance of high ability managers in choosing ESG projects. The quality of management may impact whether ESG activities enhance shareholder value. And they identified high-ability managers using Glassdoor employee ratings of senior managers, and they found that the portfolio of firms with high-ability CEOs, as well as ESG investments, outperformed the portfolio of firms with low-ability CEOs, as well as ESG investments by 6.64% per year. What this shows is that both high-ability leadership and high ESG investment are needed to maximize shareholder value. This makes sense. When pressured to engage in ESG, CEOs would likely pick ESG projects that generate shareholder value because their compensation is typically tied to stock price. And the importance of supply chain ESG activities. In 2023, the author also examined the long-term value implications of supply chain ESG and the usefulness of this information to investors. Although a well-known concept, supply chain risk has been difficult to quantify because of two important hurdles. One, suppliers' identities are often hidden, and two, there's a lack of credible measures of supplier ESG practices, especially when suppliers are private. And their research looked at US-listed companies and their supply chains composed of both private and public suppliers in the US and abroad from 2009 to 2020. And they found a link between the ESG risk in a company's supply chain and its future stock returns. Specifically, the portfolio firms with the fewest supplier ESG incidents exhibited excess return of 6.77% annually. The returns they observed were generated largely in three ways. The first is supply chain stability. With fewer shocks and disruptions, companies can fulfill customer orders, optimize inventory, and operate more efficiently. The second is that responsible sourcing policies attract socially conscious customers and investors, and helping companies avoid supply chain problems that can damage their brand and reputation. And third, ethical sourcing can hedge regulatory risk and reduce legal liabilities. So why should ESG efforts be related to shareholder value? Simply stated, it is because ESG activities are investment activities that consume the resources of the firm. As such, investors who should be making bets on how effective different firms are in generating returns on their respective investments must exercise due diligence to uncover the link between firm ESG efforts and shareholder value. So that's everything for today. Over and out, and live a sustainable life.